Hi. Let's learn about contract for differences, CFD, definition, uses, and examples. Today, we will talk about contract for differences, CFD. A contract for differences is an arrangement made in financial derivatives trading where the differences in the settlement between the open and closing trade prices are cash settled. There is no delivery of physical goods or securities with CFDs. CFDs allow traders to trade in the price movement of securities and derivatives. Essentially, CFDs are used by investors to make price bets as to whether the price of the underlying asset or security will rise or fall. CFDs can be used to trade many assets and securities including exchange-traded funds and commodity futures contracts such as those for crude oil and corn. Contracts for differences can be used to trade many assets and securities including exchange-traded funds. Typically, fewer rules and regulations surround the CFD market as compared to standard exchanges, and traders have easy access to any market that is open from the broker's platform. CFDs provide traders with all of the benefits and risks of owning a security without actually owning it or having to take any physical delivery of the asset. CFDs are traded on margin, meaning the broker allows investors to borrow money to increase leverage or the size of the position to amplify gains. Also, since CFDs mirror corporate actions taking place, a CFD owner can receive cash dividends, increasing the trader's return on investment. Paying a large spread on entries and exits prevents profiting from small moves in CFDs, decreasing the number of winning trades while increasing losses. And, since CFDs trade using leverage, investors holding a losing position can get a margin call from their broker, which requires additional funds to be deposited to balance out the losing position. An investor wants to buy a CFD on the SPDR S&P 500 and the broker requires 5% down for the trade. The investor buys 100 shares of the SPY for $250 per share for a $25,000 position, and 2 months later the SPY is trading at $300 per share, and the trader exits the position with a profit of $5,000. Here are 3 key takeaways. 1. A contract for differences, CFD, is a financial contract that pays the differences in the settlement price between the open and closing trades. 2. CFDs essentially allow investors to trade the direction of securities over the very short term and are especially popular in FX and commodities products. 3. CFDs are cash settled but usually allow ample margin trading so that investors need only put up a small amount of the contract's notional payoff. Hope this would help. Thanks for watching.